Hi guys, my name is Tom. Welcome to this week's video on explaining the Greek term gamma. Over the course of weeks and months, we're going to teach different option terms, strategies, and techniques to our viewers. Our ultimate goal is to educate you about the wonderful and highly profitable world of option trading. As always, do not forget to click the link and to subscribe to this page. You'll receive alerts when we post new content. Please also check out our website and our social media pages on Facebook, Instagram, and Twitter. So let's jump into this week's topic, which is focusing on gamma. Before we do that, let's do a quick refresher on what the collective Greek term means. Greeks is a term used in option market to describe the different dimensions of risk involved in taking on an option position. These variables are called Greeks because they are typically associated with the Greek symbol. Each risk variable is a result of an imperfect assumption or relationship of the option with another underlying variable. Traders use Greek values such as delta, theta, gamma, and others to assess option risk and manage option portfolios. Trying to predict what will happen to a price of a single option or position involves, it's very difficult undertaking. This is because option prices do not always move in the direction or in conjunction with the price of the underlying asset. It's important to understand what factors contribute to the movement in the price of the option and the effect they have. Options provide a way of measuring the sensitivity of the option's price to quantifiable factors. So let's look at gamma. So gamma represents the rate of change between an option's delta and the underlying asset price. This is called second order or second derivative price sensitivity. Gamma indicates the amount of delta which would change given a $1 movement in underlying security. For example, assuming an investor is long one call on a hypothetical stock, XYZ, their call option has a delta of 0.5 and a gamma of 0.10. Therefore, if the stock goes up, increases or decreases by $1, the call option's delta would increase or decrease by 0.1. Gamma is used to determine how stable an option's delta is. So a high gamma value indicates that the delta could change dramatically in response to even small movements in the underlying stock. Gamma is used to determine how stable an option's delta is. Gamma is high for options that are at the money and low for options that are in and out of the money. They, accelerate in magnitude as expiration approaches. Gamma values are generally smaller the further away from the date of expiration, and options with long expirations are less sensitive to delta changes. As expiration approaches, gamma values are typically larger as price changes have more impact on gamma. Option traders may opt to not only hedge delta, but also gamma in order to have a delta-gamma neutral, meaning that if the underlying price moves, the delta will remain close to zero. Important to understand gamma because we talked about delta previously, and gamma kind of looks at if it's going to change a lot, that $1 change. Let's go into a brokerage platform now and look at what gamma is and then compare it to the delta. So we've jumped into our brokerage platform. We're going to compare gamma and delta here. Well, we're going to look at, today we're focusing on gamma, but as we know, it's a second derivative price sensitivity. So as I mentioned, gamma represents the rate of change between the option delta and underlying asset. Gamma is used to determine how stable an option delta is. So if the gamma's high gamma value indicates the delta could change dramatically in response to even small price movement. So here we have relatively, low gamma going up to high. Why is that? Well, here, if the underlying stock price goes up 1, this option price will go up 1. However, here, because the delta is 0.5, if this goes up 1, it's only going up 0.5%, 0.5, and then as it goes down, lower and lower and lower. As you can see with the gamma, it gets higher and higher in here as you approach at the money, and then it gets lower and lower and lower because it's affected there. So, gamma is high for options that are at the money and low for options that are in and out of the money. So it's high around here, meaning that they are susceptible, that delta could change dramatically in response to even small events. So that's where it's just kind of measure of the delta. Whenever I have delta on to look at, the price sensitivity, if I'm looking at kind of measuring different price movement, the price went up $10, but the underlying option didn't do it, I'll look at the delta, but also you need to understand that the gamma is like a second derivative price setting. So it's gamma's built upon the back of the delta, and understanding how the delta is calculated is about looking at the gamma. So anyway, that is the that is the Greek symbol gamma, using it in conjunction with the delta. Thank you so much for watching this week's video on gamma. If you like this page, please click the subscribe button. Please also check out our website and our social media pages on Instagram, Facebook, and Twitter. Thank you so much. Bye-bye.